Central banks bought over 1,000 tons of gold in the last 12 months. That's the highest accumulation in 50 years. The world's wealthiest investors, the people managing trillions of dollars, are moving into gold at rates we haven't seen since the 1970s. Gold is up 65% from a year ago, and the people who understand markets better than anyone else on the planet say they're still underweight. They're still buying. Why? What do they know that you don't? At Davos 2026, Ray Dalio stood in front of the world's most powerful investors and said 5 words that changed everything. The monetary order is breaking down. Not might break down, not could break down, is breaking down right now. And when monetary orders break down, when the global financial system starts cracking, there's only one asset that survives every single time. It's not stocks, it's not bonds, it's not real estate, it's gold. In the next 20 minutes, I'm going to show you exactly what's happening, why billionaires and central banks are positioning themselves right now, and what you need to do before this window closes. Because the people who act in the next 12 to 18 months will preserve their wealth. People who wait will watch it evaporate. Let me show you what they know. At the World Economic Forum in Davos this January, Ray Dalio gave an interview that should have been front page news everywhere. But most media ignored it because the message was too uncomfortable. He was asked a simple question. Are we on the brink of a capital war? His answer, we are quite close, and it would be very easy to go over the brink. Let me explain what that means. You've heard about trade wars, countries putting tariffs on each other's goods. That's visible, that makes headlines. But capital wars are different. Capital wars happen when countries stop trusting each other's money, when they stop holding each other's debt, when they start protecting themselves by moving into hard assets that can't be printed, can't be sanctioned, and can't be controlled by anyone else. That's what's happening right now. Dalio explained it clearly. Countries that hold US dollar-denominated assets are worried. They're worried about sanctions. They're worried about devaluation. They're worried about being trapped in a system where the rules can change overnight. And on the other side, the United States is worried too. Worried that other countries won't keep buying treasury debt. Worried that the dollar's reserve currency status is under threat. Worried that the supply and demand dynamics are shifting. When both sides are worried about each other, when mutual fears exist, you get capital flight. Money moves, not slowly, suddenly. And where does it move? Into the second largest reserve currency in the world, gold. This isn't speculation, this is happening. The data is public. Central banks in China, Russia, Turkey, India, and dozens of other countries have been accumulating gold at record rates. They're not buying gold to speculate on price movements. They're buying gold because they're preparing for what comes next. And what comes next is the breakdown Dalio is warning about. Here's what you need to understand about where we are right now. Total debt in the global economy is at levels we've never seen before. U.S. government debt alone is $38 trillion. Corporate debt, consumer debt, state and local government debt, all of it combined, over $90 trillion. The federal government now spends over $1 trillion per year just paying interest on existing debt, more than defense, more than education, just interest. When interest costs exceed defense spending for the first time in modern history, that tells you something. The debt load is unsustainable. Dalio has studied 500 years of economic history. He's mapped every major debt cycle since the Dutch Empire. And he's reading the machine right now. The machine is screaming that we're in the late stages of a long-term debt cycle. These cycles happen every 75 to 100 years. The last one was the 1930s and 40s. Before that, the 1860s. And when these cycles end, they don't end quietly. They end with massive wealth transfers from people holding paper assets to people holding real assets. Here's why this matters for you right now. When you're at the end of a debt cycle, governments and central banks only have 3 options: defaults, restructuring, or inflation. Defaults mean bankruptcy, massive wealth destruction. Nobody wants that. Restructuring means renegotiating the debt. You owed $100, now you owe $50. Great if you're the debtor, catastrophic if you're the lender holding bonds. Inflation is the path they always choose. Print enough money and the debt becomes worthless in real terms. The dollars in your account, the dollars in your retirement funds, the dollars you've been saving for 30 years, they buy less, a lot less. And here's what Dalio said in that Davos interview: we're producing too much debt. That means I don't want that kind of money. Think about that. One of the most successful investors in history managing $124 billion saying clearly, I don't want to hold this money anymore. Where is he putting it instead? Gold. Let me tell you a story that will make this concrete. In 2019, a Russian billionaire moved $200 million into physical gold. His friends in Moscow laughed at him. They said gold pays no interest. Gold just sits there doing nothing. You're leaving money on the table. He ignored them. He kept accumulating. By early 2022, he had moved over $300 million into gold bars stored in Switzerland, Dubai, and Singapore. Then February 2022 happened. Russia invaded Ukraine. Within 72 hours, the West froze over $300 billion in Russian central bank reserves. Oligarchs woke up to find their bank accounts frozen, their real estate seized, their yachts impounded, billions of dollars, unreachable. But that billionaire, his gold was safe, liquid, movable. He could sell it, he could borrow against it, he could move it to different jurisdictions. Nobody could freeze it, nobody could sanction it. His friends who laughed at him, some of them lost everything, not because they weren't wealthy, but because their wealth was trapped in a system that turned against them overnight. That's what gold does. It's the only money that exists outside the system, the only asset you can own without needing anyone's permission. And when capital wars start, when financial weapons get deployed, gold is the only thing that can't be weaponized against you. Now, let me tell you about someone closer to home. A woman named Jennifer reached out in 2020 during the COVID panic. She was 52 years old. She had $850,000 saved, and she was terrified because she'd watched what happened in 2008 and didn't want to experience that again. I told her what I'm telling you now. When debt cycles end, you need to be positioned in assets that central banks and billionaires are buying, not assets that retail investors are buying. She listened. She repositioned 12% of her portfolio into physical gold, not gold ETFs, not mining stocks. Physical metal stored in secure vaults across 3 different countries. She put 35% into businesses with pricing power, companies that can raise prices faster than inflation. She kept 25% in short-term treasuries for optionality, and she allocated 15% to productive real assets. 2020 to 2025 was volatile. Stocks went up and down. Bonds got destroyed when rates rose. But Jennifer's portfolio held steady. The gold position protected her when everything else was falling. The businesses with pricing power thrived during inflation. The cash gave her the ability to buy during panic. She's 57 now, on track to retire at 62 with more than she ever thought possible. Not because she got lucky, because she positioned herself the way billionaires position themselves. The difference between these two stories and the thousands of people who lost everything: action. They didn't wait. They didn't ask permission. They saw what was coming and they moved. Now let me explain exactly what Dalio means by capital war, because this is the threat nobody's talking about. Think of it as a financial weapon. In 1956, Britain and France invaded Egypt during the Suez Crisis. The United States opposed the invasion. And America had a weapon more powerful than tanks or bombs. The U.S. Treasury threatened to dump British government bonds and destroy the pound unless Britain withdrew immediately. Britain withdrew within 48 hours, not because of military pressure, because of financial pressure. That was a capital war. using money and debt as leverage, using the threat of financial destruction to force political outcomes. Dalio is saying we're dangerously close to that happening again on a much bigger scale. Here's what's actually happening right now. Countries are reducing their holdings of U.S. treasuries. China has reduced its treasury holdings by over $300 billion in the last 3 years. Japan is reducing. European central banks are reducing. At the same time, those same countries are massively increasing their gold reserves. China added over 225 tons of gold in 2025 alone. Turkey increased reserves by 160 tons. India bought over 75 tons. Why? Because they see what's coming. When conflicts arise, even allies don't want to hold each other's debt. They prefer hard currency. This is logical. It's factual, and it's repeated throughout history. The U.S. can freeze assets with sanctions. China can dump treasuries to crash bond markets. Europe can restrict capital flows. But gold, nobody can freeze it. Nobody can sanction it. Nobody controls it. If you're a country worried about capital wars, you move into gold. If you're a billionaire worried about sanctions, you move into gold. And if you're an individual worried about your life savings evaporating, you should be thinking the same way. Because what protects sovereign wealth funds protects you too. Dalio was asked directly at Davos, what should people do with their money right now? His answer was precise. If you don't have views on markets, if you're not trying to trade or time things, you should have a well-diversified portfolio. And in that portfolio, gold should represent 5 to 15% of your assets, not because you're betting that gold will go up, but because gold does something unique. When other assets are collapsing, gold holds value or goes up. Let me show you the historical pattern. In the 1930s, when stocks dropped 89%, gold was revalued higher by governments desperate to reflate their economies. People who held gold survived. People who held stocks and bonds were wiped out. In the 1970s, when bonds and stocks both got destroyed by inflation, gold went from $35 per ounce to $850, a 24 times return. Someone who put $10,000 into gold in 1970 had $240,000 by 1980. In 2008, when the financial system nearly collapsed, gold went from $800 to $1,900 while everything else was crashing. And right now, from 2024 to 2026, gold is up 65%, while bonds have been losing value, while stocks have been volatile. But here's what Dalio said that most people miss. Even after gold's 65% rise, central banks are still short. They should be holding more than they currently have based on optimal portfolio allocation. That means the buying isn't done. The reallocation into gold is still in its early stages. Think about what that means. If the smartest institutional investors in the world, managing trillions of dollars, say they need to buy more gold even after a 65% run, what does that tell you? It tells you the price isn't the point. The allocation is the point. You don't buy gold hoping it goes up 20% next year. You buy gold because when the monetary order breaks down, when currencies collapse, when debt crises hit, gold is what survives. It's insurance, and insurance always has a cost. In good times, gold underperforms stocks. That's fine. That's what insurance does. But in bad times, when your stocks and bonds are getting crushed, that 10% or 15% allocation to gold could be the difference between preserving your wealth and watching it evaporate. Here's the systematic approach. Not panic, not speculation. A system. Step 1. Calculate what percentage of your portfolio should be in gold. Dalio recommends 5% to 15%. If you have $100,000 saved, that's $5,000 to $15,000 in gold. If you have $500,000, that's $25,000 to $75,000. Don't try to time the entry. Don't wait for a pullback. Just establish the position at whatever the current price is. Because you're not trading, you're allocating. Step 2. Buy physical gold. not gold ETFs, not mining stocks, physical metal that you own and control. You have three options. Buy directly from dealers like APEMEX or JM Bullion. Use allocated storage services like Bullion Vault, where you own specific bars, or visit local coin shops for smaller amounts. Start with 1-ounce gold coins. American Eagles or Canadian Maple Leafs. For silver, consider 10-ounce bars or 1-ounce rounds. Expect to pay a small premium above spot price, typically 3 to 5% for gold. Never buy collectible coins. You want bullion, pure metal, nothing fancy. Step 3, store it securely, not in your house. In a professional vault, ideally across multiple countries. Switzerland, Singapore, Dubai. Because if capital controls or confiscation ever happen, you want geographic diversification. Step 4, stop thinking about it. This isn't a trading position. This is a strategic allocation. You're not checking the price every day. You're not selling when it goes up 10%. You hold this position for years, maybe decades. You hope you never need it. But if the dollar loses 50% of its value over the next 10 years, that gold doubles in dollar terms while everything else is collapsing. Step 5, rebalance once per year. If gold goes up so much that it becomes 20% or 25% of your portfolio, sell some to get back to your target. If it goes down to 3% or 4%, buy more. You're maintaining a steady allocation, not chasing performance. This is how professionals manage money. This is how sovereign wealth funds and central banks operate. And this is how you should be thinking. Let me tell you what's going to happen. Most people watching this will nod along. They'll think, yeah, this makes sense. Dalio is smart. Central banks are buying gold. Maybe I should do something. And then they'll do nothing. They'll talk themselves out of it. Maybe this is too pessimistic. Maybe I should wait and see what happens. Maybe gold is too expensive after going up 65%, and their financial advisor will tell them to stay the course. Because advisors make money when you're invested in their funds. They make nothing when you buy physical gold that sits in a vault generating no fees. So you'll listen to them. Because it's easier, because change is hard, because buying gold feels weird when everyone else is buying stocks. And then, in 12 to 18 months, when the crisis Dalio is warning about becomes obvious to everyone, you'll remember this video. And you'll think I should have listened. But by then, it's too late. Gold at $3,000 or $4,000 per ounce. Premiums through the roof because everyone is trying to buy at once. Dealers running out of inventory. Delivery time stretching to months. You'll still be able to buy, but you'll be buying at prices 50% or 100% higher than today. And you'll have missed the window when positioning was easy. Here's what separates the people who preserve wealth from the people who lose it. Action. Not next month, not after you see what the market does, not after you ask your advisor for permission. Now, 1 gold coin today is better than 10 gold coins you can't afford next year. Here's what I want you to do right now. Before you close this video, pull up a calculator. Look at your portfolio. Calculator 10% of your liquid assets. That's your target. Then open a new browser tab. Go to APEMEX or JM Bullion or Bullion Vault. Create an account. It takes 5 minutes. Then buy your first position, even if it's just 1 coin, even if it's just $2,000. Get started. Because the Russian billionaire didn't wait. Jennifer didn't wait. Central banks aren't waiting, and you shouldn't either. Ray Dalio manages $124 billion. He's navigated every major crisis for 50 years. He predicted 2008. He called the dot-com crash. And he's telling you clearly, right now, the monetary order is breaking down. Central banks know it. Billionaires know it. Sovereign wealth funds know it. Now you know it too. The question is what you're going to do about it. Calculate your 10%, buy your first ounce, join the central banks, go.